Most people think buying a house is a milestone, an investment, or simply the next stage of adulthood. But financially, a home purchase is something much, much bigger. It is a leverage event, a liquidity transformation, a net worth statement restructuring, and a complete redesign of the household operating system. Because the moment a household transitions from renting to owning, everything changes. Cash flow structure, financial flexibility, recurring obligations, survivability, and future optionality. And critically, the household may appear wealthier externally while simultaneously becoming more fragile internally. So in this video, we're going to analyze the transition from renting to owning using accounting, financial planning and analysis, financial statement analysis, and systems engineering. Because the true question is not, can you qualify for the mortgage? The real question is, what happens to the entire household system after ownership enters it? Before ownership enters the system, we first need to understand the structure of renting, because renting is often misunderstood financially. Many people treat rent as throwing money away. But from a systems perspective, renting actually purchases something very valuable: flexibility, mobility, reduced leverage, and preserved liquidity. This is extremely important because financially, renting behaves more like an operating expense model. The household pays for shelter, utility, adaptability, and optionality preservation. And structurally, the rental model often produces lower fixed obligations, lower maintenance volatility, lower leverage exposure, and lower liquidity compression. But it also produces no equity accumulation, no mortgage principal reduction, and limited participation in housing appreciation. This creates a fundamentally different financial architecture. Let's look at a rental structure example. Suppose monthly rent is $2,200. The household recognizes recurring shelter expense, but no asset accumulation and no long-duration debt obligation. In other videos, I've shown how the entire contractual obligation of the rental agreement should be realized as a current liability, and that current liability should be basically turned into an expense over the period of the contract, up to the point where we get, you're in the 60-day window where you could give 60-day notice. I would highly recommend checking out that video for further elaboration on the accounting of rent. What this means is the system retains mobility, flexibility, and faster adaptation capacity. That flexibility has real economic value, especially during layoffs, economic downturns, career transitions, or geographic relocations. Now let's look at the contribution margin perspective. This becomes critically important. Under a rental structure, housing behaves more like a variable operational commitment. The household can relocate, downsize, renegotiate, or exit more easily. This reduces structural rigidity and household operating leverage, although only to a certain extent, because typically rent will be treated as a lifestyle fixed commitment. But like I've mentioned before in other videos, any fixed expense given a long enough time horizon can become variable. So what this does is it reduces structural rigidity and household operating leverage, or what we've been calling lifestyle leverage. And that distinction matters and becomes enormously important later on. Now the household transitions into ownership, and financially this resembles a leveraged asset acquisition. This is one of the largest financial restructuring events most households will ever experience, because simultaneously a massive asset enters the system and a massive liability enters the system. This is critically important because ownership often increases net worth exposure while simultaneously reducing liquidity, flexibility, and shock absorption capacity. That trade-off is the core systems issue. So let's suppose that the household purchases a $700,000 home with $140,000 as a down payment and a $560,000 mortgage. And we're simplifying things. We're leaving out other fees that are involved, but just know that there are a lot of other fees that are included in a type of transaction like this. Under the one row accounting structure, we're going to debit our account for the cash that we receive from the mortgage. We're going to credit the mortgage payable, and that amount is going to be $560,000. So on our balance sheet, if we were updating it in real time, when this transaction happened, cash would increase by $560,000, and we'd realize this mortgage payable liability on the right-hand side of our net worth statement for $560,000. What happened economically? The household's liquidity temporarily rises, but leverage simultaneously rises dramatically. This is a critically important systems insight because cash inflow alone does not mean the system became stronger. Future obligations have now entered the architecture. Next, we deal with the actual purchase. We debit our house asset and we credit our cash account for the amount of $700,000. This is the amount that the house costs. This is capital deployment. The household converts liquidity into long-duration real estate infrastructure. But unlike renting, this structure now introduces mortgage payments, and those mortgage payments will consist of principal and interest, property taxes, sometimes bundled into the payment, which further complicates the accounting, insurance, maintenance, and repair volatility. The system has fundamentally changed. Now, the house purchase begins propagating through every financial statement simultaneously. This is where the household operating system is completely reconfigured. Let's first deal with the income statement effects. Ownership introduces mortgage interest, property taxes, home insurance, utilities, maintenance, repairs, and potentially condominium fees. This is critically important. Mortgage principal repayment is not an expense. Only interest, taxes, insurance, maintenance, and related operating costs flow through the income statement. This distinction is foundational accounting logic. Next, let's turn to the net worth statement effects. Now the house asset appears, the mortgage liability appears, and equity becomes the residual portion between the two, along with other assets and other liabilities. This creates leveraged net worth exposure, meaning small changes in housing prices can massively amplify gains or losses to household equity. That is classic leverage amplification. Turning to the cash flow statement effects, the house purchase now reshapes living or lifestyle cash flows, investing cash flows, and financing cash flows. First, let's deal with financing cash flows. The mortgage proceeds are a cash inflow. The mortgage principal repayment are cash outflows. From the operating cash flow or the lifestyle cash flow section, interest payments show up as a cash outflow. Property taxes, insurance, utilities, and maintenance are all cash outflows. And most of these are going to be captured within the net income figure. As far as investing cash flows are concerned, major renovations, capital improvements, and structural upgrades. This is where the system becomes extremely complex because housing is simultaneously consumption, financing, investing, and infrastructure. Very few financial decisions operate across all four dimensions simultaneously. Next, the contribution income statement effects. This may be the most important section. because housing behaves heavily like a fixed cost structure. As housing obligations rise, the household's discretionary cash flow, adaptability, and contribution flexibility begin declining. This creates household operating leverage, or what we've been calling lifestyle leverage. And higher operating leverage means small changes in income produce disproportionately large effects on financial stability. That's the exact same logic used in corporate finance. Now the long duration pressure system begins, the mortgage amortization schedule. This is not simply a payment schedule. It is a map of future financial pressure through time. Every mortgage payment contains interest expense and principal repayment. And critically, those two components behave very differently financially. In the early years, interest dominates, meaning the household may feel highly cash constrained while equity accumulation progresses slowly. This creates reduced flexibility, elevated obligation pressure, and greater dependence on stable income. This is one of the most misunderstood realities of home ownership. Let's look at the financial statement propagation. The area of income statement, the effect on it is interest expense. For the net worth statement, the effect is the mortgage liability reduction through those principal payments. The cash flow statement, the cash flows from lifestyle, will show the interest payments as a cash outflow. And the cash flow statement for financing, this will show the principal repayment as a cash outflow. One payment propagates through multiple statements simultaneously. That is why accounting is systems engineering. Let's now look at structural pressure through time. As mortgage obligations rise, liquidity compresses, fixed obligations increase, and future optionality narrows. The system becomes increasingly dependent on continued income stability, stable interest rates, and economic continuity. This is where survivability risk begins emerging. At this point, the household may appear wealthier, more established, and financially stronger externally. But internally, the structure may now carry significantly higher leverage, lower liquidity, greater rigidity, and higher shock sensitivity. And this is where most personal finance discussions stop. But the real systems analysis begins now, because in Part B, we are going to examine liquidity deterioration, solvency pressure, degree of lifestyle leverage, degree of financial leverage, fragility under stress, optionality collapse, and survivability during uncertainty. Because a house purchase is not simply buying shelter, it is a long-duration restructuring of the household financial operating system.